let's talk about affordability. Let's talk about housing prices. Let's talk about the reality of what's actually happening out there. So tell me a little bit about what's going on in your neck of the woods. Obviously, you're on Vancouver Island. I know you guys do a lot of business on the mainland as well. And this is one of the most expensive real estate markets in the world. Are houses still affordable? Are people still buying? Like, what's happening in these expensive markets that you guys are so closely tied to?
Well, I think it's funny because in the lower mainland, we went through 2 years ago, went through multiple offers. Nobody's putting, they're not selling their house before they're buying. There was all kinds of huge issues going on with people 2 years ago. And all of a sudden it stops, it slows down, it starts to drop a bit. Well, everybody you talk to on the mainland now says, hey, we're back into multiple offers again. I think things have settled down and they're stable, but it's still expensive to buy a home. But in the same respect, in our market area, we've seen a lot of people that are not living in downtown Vancouver anymore. They're moving out to the rural areas, right? So, and before, where Burnaby and Coquitlam and Port Coquitlam were affordable, now people are moving to Mission and Abbotsford and that kind of stuff. So that's happening on the mainland. On the island, specifically in Nanaimo, when we moved over here, when Miles was, God, that was 25 years ago. So you were what, 8?
I was in grade 3.
Okay, so moved over when we were 8. There were 64,000 people in Nanaimo proper, and now there's 115,000.
Yep.
And they figure that's going to double a lot faster than it has in the last 25 years. So, and on our street, for example, there's I think there's 4 brand new people that have moved in that have come here from the mainland because they now work from home. So, it's the prices locally here. People think the prices are high, but they're not. Right. So, the bigger centers, obviously it's more expensive and you may be having to buy a home with a basement suite in it, but that's how we did it before. So, and we bought jokingly, we talked about it the other day, but bought my first house in Victoria in 1983. I think I paid $62,000 for it. My interest
What's
rate
it worth now?
17.5%.
Yeah, but what's it worth now?
I don't know, $1.3 million.
I'd say more than that. If it was,
Yeah,
was it downtown Victoria?
Yeah, it's Fort and Foul Bay. It's kind of in an older area, and it was a 1911 house. So
we can say it's like a $1.5 million house at this point.
Yeah, but
it's crazy to think about for me, though. I mean, like when I talk about house affordability and stuff like that too, and I mean it's different for me because I'm also 33, right? Like I haven't seen the peaks and the valleys and the different cycles that other people have seen. But like when I look at it, it's okay. So you got a house that's worth $60,000-$70,000. And then 30 years later, it's worth $1.5 million. How much money, like respectively, were you making at that point in time? Probably, I think I've heard this story, so I know the answer.
Yeah.
Like $70,000 between you and Mom.
Yeah, between Cindy and I, we're probably making $60,000 between the two of us.
So I mean, when we look at affordability, just with the prices and how they've moved, that house is worth $1.5 million now. Have incomes gone up to match that? And in my opinion, the answer to that is no. And we can't, of course, just boost incomes to match what the cost of a house is. That's not how it works. But it's something that should be taken into consideration when looking at the actual aspects of affordability, right? Because if all of a sudden something's increasing in value by hundreds of percent at a time and income isn't going up that fast, you kind of get stuck in that spot of how do I qualify? How do I buy this home? How do I get into it? And I think that's when you really want to look at it and start working with professionals who work in that industry and talking to them before you actually even start looking, because you want to build that strategy behind it. Because, you're not having an income to debt servicing ratio of, equal value. You're way off. You're making $150,000 a year and buying a house that's $1.5 million. So you have to have those strategies.
What's the market like in Calgary, Nolan? Like, give us some feedback on where you've seen things going and where it's been.
Yeah, I mean, I can talk about that. I do kind of want to circle back to what Miles was just talking about there, though, because that's one of the big fallacies and one of the big issues with, there's guys out there who are real estate doomers, and they use this price to income ratio, and they say if it gets past 4 or 5, that's when things are going to hell in a handbasket. And what price to income ratio neglects is it neglects the fact that interest rate costs come down or mortgage rules change. So when Greg bought that house ages ago, like 400 years ago, right? Sorry, Greg.
When it was
he actually had to use a hammer and chisel to sign the paperwork.
Yeah, exactly. So I mean, at that point in time, interest rates were higher. Yep. You had to get a 25-year mortgage.
Yeah.
He probably had to put considerably more down, and it was a different there was different criteria there. So that's
Yeah.
the problem with that, with that ratio that's often used by guys like Garth Turner. And I mean, the guy looks at that ratio and tells everybody, well, real estate prices are going to go down, and eventually he's going to be right, and he was right here the last couple of years, or the last year or so. But the problem is when you look at economic data and you look at it from the perspective of something that doesn't tell the whole story, it holds
Yeah.
all else equal when not all else is equal. It's called ceteris paribus in economics. That's where you kind of, it creates issues for the real estate industry, and then a consumer grabs onto that and is like, oh shoot, this ratio's out, so I shouldn't buy a home. And it's like, well, yeah, but you forgot to factor in the other 9 things. So,
Yeah. Well, and I
I
think
think,
that's sorry.
go ahead.
Oh, I was going to say that's where like having a group like this is valuable because, like I said, I don't have all the data. I don't have all the knowledge and the information because I mean, I can read as much as I want on YouTube. That's not going to compare even close to the knowledge that Greg would have when it comes to having a mortgage in the 80s. Like, I can watch everything I want, but until I hear it from someone who's gone through it and lived it, you don't know, right?
Absolutely.
Well, and yet we talk about sort of a generation before me because I am older than dirt. But at 30, 31, my dad is 84, and they had a house in Victoria that they were paying 18, 19, 20%. And when they sold in 1981, what a terrible time to sell. And I think the key there is that to get into the housing market just saves you having to pay rent. So at least you're saving something.
Yeah.
And I think that's what people forget is that if my payment is $300 more than what my rent is, still 40% of what my total payment is going towards paying my principal down. So at least I'm saving some money, and I don't have to save for buying a house anymore. And it's just some simple things that people forget about. The other thing that we saw is when I started in the industry, people would buy a condo in Vancouver, and then they would upgrade to a townhouse, and then they would buy a little single family, and they would sort of go from there. Whereas now we've seen so many younger people that want to get into that third home already. Like
They kind
start
of
at
want to
number
skip the
3.
line, right?
Yeah.
Yeah.
And and also seeing people, and getting parents to help, because you know what, like I always say, like, help your kids, because when I bought my house it was 62,000. So we've got to make sure the kids can get into the housing market. And parents bought their first house at 62 and it's now worth 2 million. Like, you got a ton of equity. Help your kids out.
Well, and that's where I was talking about strategizing too, right? Like, I mean, one thing I found with working with a lot of first-time homebuyers and young people who are getting into their home, and I mean, we're seeing first-time homebuyers getting, dare I say, older. Like, you're not buying your first house in your early 20s anymore. Some people are, but it's more common to see them push a little bit further. And a lot of them don't want to ask their parents for help. They don't want to ask for that help. And I keep telling them, like, you know what? There's no shame in asking for that assistance and buying the house, because it does give you that foot forward, because you're immediately building equity in that property you own. It's like a forced savings account. And I mean,
Yeah.
even with interest rates where they're at right now, you're still building equity.
Totally.
It's don't be ashamed to ask for help. Everyone needs help.
Have you guys seen the most recent stats out of Stats Canada with respect to owning a home and the net worth benefit at retirement? It's like, so they look at they looked at this broad scope of people, and specifically they looked at renters versus owners at retirement, and renters on average had a net worth of $40,000.
Yeah.
Guess what homeowners' net worth typically was? 700,000.
Yeah.
So
Wow.
and this is what drives me crazy about like YouTube, right? Is when you look at when you go on YouTube and you go and you look at some of the channels about personal finance, like there's this one guy, his name's Steve Antonioni, makes amazing content, and did an amazing video on renting versus buying that made it seem like renting was the better option. But what it discounted was the fact that psychology comes into play. And when you're renting versus owning makes it so that you have to put money aside every single month. It's a forced savings account. Renting, on the other hand, in theory, could be deemed as something that is more financially beneficial if you actually went and put a whole bunch of money aside every month. But it's like what psychology tells us and what history tells us is that people don't do that. So
Yeah.
the single fastest way to build a net worth and the single most certain way to build a net worth is to actually own a home and then also do the saving on top of that. Now, I brought up this housing affordability index because the one thing I see with millennials a lot, and I think millennials get a bad. I'm a millennial. My wife is not. She's older than me. I thought I'd put that on the show just so I could get in trouble later.
Yeah, you're yeah.
I mean, just texted her and said you said that.
Perfect. We might have to edit that out. But millennials get a bad rap for being entitled, right? But the one place where I see a lot of millennials be really entitled is when they look at the first home that they're going to buy, and they're expecting to buy an average home
Right.
at an average price at a less than average income because they're just new into the workforce. And what I find really interesting about RBC's housing affordability index, which I think is probably one of the best statistics in the industry, if you want to see where your markets are, and they break this all out by individual city and whatnot. And by the way, it's forecast that affordability is going to get better over the next year or two. But what I look at this number with respect to condo apartments, and we know as mortgage brokers that 40 to 42% of income is kind of where housing is affordable and where it's not. And if you look at where condo apartments are, they're very much affordable if you look at Canada as a whole. Now, there's going to be markets where they're less affordable, markets where they're more affordable. But if a millennial comes into the market with the expectation that they're going to have to start at an entry-level property, which is not a single-family detached home, and purchase that property, build some equity, and then eventually be able to purchase a bigger home and get into that one that they're going to be able to have a family in, then they're starting with the right foot forward. Now, the big problem for a lot of millennials is they spent the last 10 to 15 years skipping the entry to the real estate market, and now they're so far behind. The question is, are they ever going to be able to purchase the house they need because now they've had 2 kids?
Now they got the family and everything
else, right? So,
well, that's where the bank of dad and mom come into play.